I'm Selena Wang. This is Bloomberg Technology. Coming up, Amazon breaks the internet, how a problem in the cloud triggered the error message sweeping across the East Coast. Plus, the final countdown to the Snap IPO with just 24 hours to share pricing. We highlight some of the biggest investor concerns. And Kalanick gets his close-up, and it's not a good look. How the Uber CEO was caught on tape in a video handed over to Bloomberg. But first to our lead. A massive internet disruption hit the East Coast of the U.S. with Amazon's web service to blame. Amazon said it was working to repair its S3 data storage system that is used by nearly 150,000 websites. Joining us on the phone from Seattle, Bloomberg News reporter Spencer Soper, and with me in San Francisco, Bloomberg Technology Senior Executive Editor Brad Stone, who is my co-host for the hour, as well as Ryan Sarver, Redpoint Ventures partner. Spencer, I want to start with you. What's the latest on the developments? What do we know about what caused this and why AWS's servers are down?
Well, we don't know what caused it. We know it's affected, thousands of sites out there using this S3 service, which is what they describe as a simple storage solution. It can be used to house data and manage web applications and host software that customers download from the internet. Amazon has been posting updates on its site, which seems kind of reassuring, but the language is a little, can be interpreted multiple ways, like they believe they have a handle on the root cause and that sort of thing. So it's a lot like talking to your mechanic while he's fixing your car. But that's the latest is just that they're working on it, trying to fix it, and they keep posting these updates that they think they're getting closer.
Ryan, AWS is mission critical for so many organizations. I mean, the CIA pays Amazon tens or maybe even hundreds of millions of dollars a year, right? Startups all across Silicon Valley are dependent on AWS. Does anybody use a day like today to reconsider that investment?
No, I think today is about understanding what the durability in the system is and if there are ways to make sure you can try and mitigate it and be kind of multi-source. But I think the shift to cloud and shift to Amazon or other similar services is pretty inevitable. And so that move continues, but it's about trying to figure out how you become more robust.
And Ryan, what do we know about what types of customers were harmed by this? I mean, how damaging really is this for them?
I think from the bit I read, it was on East Coast focus. It was the East Coast Data Center, East Coast AWS. But it looked like it took out a wide swath of customers across all sectors who were using it.
Now, over the years, this has happened to Amazon periodically, right? Not frequently, but maybe about once a year, something like this does happen. Does this infect Amazon competitors? Like, have we seen Microsoft or Google's cloud go down with that kind of regularity or frequency?
I don't know the actual stats on it. I don't think there's any one that seems more robust than the others yet. I think it just seems, where do you get the best pricing and the best features? Amazon clearly is starting to win that business. I don't think this makes many people change their point of view yet.
Spencer, this really kind of underscores just how important Amazon is to our now internet society, and it's pretty amazing that just some kind of glitch in part of its system would cause such a widespread problem. I mean, what kind of repercussions is Amazon going to face for having this problem? I mean, they really need to be held to a very high standard.
Yeah, I mean, they'll have some explaining to do to their customers and more reassurances to make, but you're right. I mean, some of the companies affected include Expensify, which is like this online expense report tool, Trello, which is kind of an online project management tool, and even like a automated email alert sent by a Metra, a commuter rail system in Chicago, was affected by this. So it was very sweeping ramifications of whatever internal problem they have, creating a lot of havoc out there with their customers.
Spencer, everyone today is checking the AWS Health dashboard. They posted this recent update at 1:12 p.m. They said S3 object retrieval, listing, and deletion is fully recovered, but they're still working on adding new objects to S3. So as our Amazon interpreter, what do they mean? And do they have to speak more frankly when this kind of outage affects the entire internet?
Well, that's it right there. I mean, I'm sure that means something to someone somewhere. I think that their public relations department, their email must run on S3 because they've been kind of radio silent today. So it has been difficult to interpret this. And again, if you read the statements carefully, there's no real clear answer on when this will be fully resolved. So it's kind of clear as mud.
Well, Spencer, thank you for the updates. We'll definitely be coming back to you for further developments on this. And Ryan Sarver, Redpoint Ventures, and Brad Stone, you are sticking with me. Now to Barcelona, where the annual Mobile World Congress is underway. But it's not just tech leaders in attendance. Regulators are there too, including the Federal Communications new chairman, Ajit Pai. Bloomberg's Caroline Hyde caught up with him and began by asking for an update on the AT&T Time Warner deal.
It's limited to these particular facts, and as I understand it, the parties have structured the transaction so that it won't come before us, and that's the reason why I said what I said yesterday.
So give us what market light actually therefore is. So would we be right? The market already is expecting it. Russell 3000 TV radio index is up. Are we going to see more M&A in 2017? Will you allow that to go through?
That's a decision, obviously, for the private sector to make. My job is a very humble and frankly boring one, which is simply to review the papers that are put before me, take a look at the facts as presented, and make a decision based on the law and the precedents that are long established. And I can't opine in the abstract about any particular transaction.
We spoke with Tom Wheeler, of course, your predecessor at the FCC as chair, and he was very much of the view that 4 players in the mobile space in the United States was what was needed for a competitive market. But you say at the moment it is extremely competitive, but I wonder whether 3 players would be enough.
I can't say in the abstract what the optimal market structure is. What I do know is that the current wireless marketplace in the United States is extremely competitive. Recently, for example, after the FCC stopped its investigation of free data offerings, every single one, all 4 of the national wireless carriers in the United States announced unlimited data plans. That's a good thing for consumers. So in the context of any transaction, our focus is always going to be what's in the public interest. And if it is in the public interest, then we would be more favorably inclined to approve a deal.
If you were to see T-Mobile US team with Sprint, would that still allow for a competitive space?
So points for trying, but unfortunately I can't opine in the absence of particular papers that present the facts before me.
And already you've moved to roll back some of the privacy rules that are surrounding broadband at the moment. This, of course, being where customers would have to opt into certain internet service providers for them to use their data, and you're wanting to scrap that. The question is this going bigger? Are we going to see you completely roll back net neutrality? Would the Title II protection no longer be enforced?
Well, that decision simply meant putting a pause on one of the rules that was going to come into effect on March 2nd. More broadly speaking, I think there's a broad consensus about the need for a free and open internet. That's the internet we've had since the dawn of the internet age in the mid-1990s, and that's something I think consumers and companies alike have come to take for granted. The only question is, what regulatory framework can we adopt that both protects that core value and preserves a massive incentive to invest in infrastructure across the United States?
That was Bloomberg's Caroline Hyde with FCC Chairman Ajit Pai. Snap is poised to be one of the most successful tech IPOs in years when it prices after the market closes tomorrow. But its unique share class structure could spell trouble for the Snapchat maker down the line. We'll dig into why next. This is Bloomberg. SoundCloud is undercutting rival Spotify and Apple Music with a cheaper monthly music subscription service. The $4.99 subscription is half the cost of SoundCloud's premium service, and it includes access to 120 million songs. The move is aimed at boosting revenue after the company warned in January that it may run out of money without more paying customers. Music industry executives say a cheaper service will draw in price-sensitive subscribers and help SoundCloud compete with YouTube and free music services. Now, Snap is poised to price shares for its IPO after the market closes on Wednesday. The parent of Snapchat seeks to raise up to $3.2 billion, the biggest social media listing since Twitter went public more than 3 years ago. But Snap has a unique shareholder structure that may raise questions for investors in the long run. Our Bloomberg's Alex Barinka has more.
Snap has most of the ingredients for a successful IPO. An edgy new social media app, sales growth, and investors who haven't had a lot of opportunities to buy into new tech stocks. But a blockbuster IPO doesn't guarantee a great public stock. There's been a growing rift between the short-term excitement and the long-term concerns about Snap. The company will need to prove itself long past listing day. It's still losing money, and user growth has recently slowed. And if there are signs that it's not going to be the next big thing, the company's unique share class structure could mean the stock's in for a bumpy ride. We've seen stocks with great IPOs go sour. For Twitter, it took about 1.5 years to lose investors' patience. Revenue growth stalled with profit nowhere in sight. Groupon's flameout came quicker as consumers soured on daily deals and losses widened. Then there was Zynga, the one-time darling of the gaming industry that failed to come up with new hits and lagged behind the competition. In Snap's case, if investors lose hope in management's vision, the stock could fall faster and farther than its peers. Why? Investors have no voting power, no ability to nominate directors, and no say on executive pay. If they are unhappy, their only recourse is, well, selling. The bull case? If Snap can rev up user growth and keep inching toward profitability, then their shareholders could enjoy returns the likes of Facebook, Netflix, or Apple.
Let's get more on the Snap IPO and the broader tech IPO landscape. Joining us from New York is Alex Barinka, and with us in the studio, Redpoint Ventures partner Ryan Sarver. So Alex, great package there. You outlined a lot of investor concerns. I mean, if you look at the current numbers, Snap's price to sales ratio is almost double Facebook's. And on top of that, they don't have profitability. It's a very new business model. And the fact that investors basically have no voting power. Don't you think this valuation is perhaps too lofty?
That is one of the things that obviously investors are talking about. But Selena, when I think about this, I'm starting to think about it in two separate groups. You have the people who are going to want to buy into this deal because they want to get into a growthy stock and ride the pop that is typical in a share price immediately after the IPO. Those folks are going to be probably a little less valuation sensitive, let's say, than the long-term investors, which is the other group of people who would consider this deal. For them, you look at the high end, it's about 19.7 times forward revenue for the next 12 months. That is, again, double Facebook. That's more than what Facebook went public at about 19.4. Twitter went public at 13 times forward 12-month revenue. So the longer-term holders who are saying, look, I'm buying this at the IPO price, and I think I'll have it for a while, they're going to be the ones who are going to be probably considering whether or not the actual fundamentals of this business and the growth opportunities actually justify the valuation of as much as $18.5 billion market value that this company is going for.
Alex, specifically, are the lack of voting rights giving any investors pause?
Again, not for the IPO. I talked to one of the partners and general counsels at Value Act who said, look, she was like, this is not going to cause investors to boycott the deal initially. But going forward, if this stock goes sideways, investors really have no recourse. If they buy something that investors don't like, they're not going to be voting on that acquisition. They can't nominate new directors, no say on pay if they think CEO Evan Spiegel and friends are getting paid too much for not doing enough. So again, you have to kind of think about it directionally. If the stock is going up and to the right, folks aren't going to complain. As soon as this thing, if it goes sour, then because there's less of a say with the voters, they're probably just going to exit, which could, inject a little bit more volatility if there are some negative wheelings and dealings going on with Snap.
But Alex, I really quickly just want to touch on the product. I mean, how can they prove that it's not just a one-hit use case among one demographic? How can it kind of avoid the Twitter conundrum and really show that it can expand its offering?
When I talk to people who are bearish on this stock going forward, that's actually the problem. You have the Snapchat app here, and on the roadshow, the management team hasn't really given a lot of clues as to what comes next. When you do think about the different phases of this company, as they like to talk about, right now they're still kind of in monetization mode. They are still trying to make money. Revenue is kind of a new thing for them. They've only been making serious money for the past 2 years. Next will come profitability. So that is the concern, that this might be just a one-hit wonder. But the execs will tell you, look, we have been able to capture the millennial audience. We are doing well in stealing ad dollars from advertisers for now in our young life. So, that's the trend that you'll have to bet on, that they can come up with what's next. Outside of spectacles, which we've seen hasn't really sold and made a big impact on the top line.
Ryan, Facebook, of course, had a rocky couple of months after its IPO. Twitter, of course, has had a rocky ride as a public company. What can social media companies learn from the trajectories of those two predecessors?
I think so much of the learnings I found from the Twitter piece was the framing of what the business and what the future opportunity was. And Twitter, unfortunately, is anchored around MAUs, and that's how people think about it. But it's such a bigger opportunity than just that. And unfortunately, all the benefit it gets around this kind of political cycle doesn't seem to be accruing to the business value. So I think it's about how these companies frame themselves as they think about going public. And that's consumer or enterprise or anyone thinking about an IPO.
Well, Bloomberg IPO reporter Alex Barinka, thank you as always. And Ryan Sarver, you're staying with Brad and myself. Now, coming up, what the future of work will look like in an increasingly automated world. We discussed next. This is Bloomberg. U.S. President Donald Trump is preparing to give his first address to a joint session of Congress. He is under increasing pressure to answer core questions about how he'll deliver on his key promises, including his pledge to bring back manufacturing jobs to the USA. Here to discuss the future of work in an era of technology and automation is our guest host for the hour, Ryan Sarver, partner at Redpoint Ventures. So Ryan, Trump has talked on Twitter about bringing manufacturing jobs to the U.S., but he hasn't really given a single tweet out about automation and its impact on saving costs and potentially also cutting jobs. What's your take on that? What do you think the future of work is going to look like?
Yeah, I mean, I think it's something we think about all the time. AI and machine learning in general has made huge leaps and bounds progress recently, and you're seeing robotics and AI make a really big impact on work. I think one study said only 13% of jobs lost over, I can't remember the exact time frame, was to trade, the rest to automation. So automation to us is the thing that really affects the job growth and the transition from low wage to high wage workers. And so I am concerned about the future for what that means for workers in the US, but it also opens a lot of opportunities for technology to potentially put them back to work.
If American companies are motivated to bring factories back to the U.S., where obviously the cost of labor is higher, where maybe they're accruing some new costs because their supply chain is overseas, does it risk the possibility of really hastening, the advancement, the automation, because companies will naturally try to cut costs?
I think 100%. You're hearing a lot of the CEOs come out and say we're already committing and investing in automation, and a force to bring that back to the U.S. will, the cost structure of the workers will force even more automation upon them. So I think it will hasten. I think you're right.
Yeah, I mean, there's even further pressure coming from Republican proposals that will put a tax import, so even more pressure to make goods at home and invest in automation. I mean, net, do you think this is going to create more jobs or less jobs overall in the U.S.?
It's hard to say. I mean, it's such big macro things, but a few things we look at, 1.7 million truckers, 1.7 million 3.4 million retail jobs in the U.S., Amazon Go, Auto, all these guys are going after those things really hard. And so I think you're going to see more and more automation hit these really big sectors. They're some of the largest employers in the U.S. So that's the stuff we look at, and I think it's concerning in some ways, but also creates opportunities.
Well, what opportunities? Where is Redpoint placing its bets?
I think, technology has always had this promise to be able to, to connect people in different geographies, right? So while the jobs might be leaving a certain region, technology can connect people on different coasts to the rest of the U.S., to the Midwest, where a lot of those jobs are being lost. Don't know exactly what those things look like yet, but we're looking a lot at what's the opportunity around technology to put people back to work. They have skills, but maybe not in the areas that they live. So
kind of a related company to this topic is Flex, a company you're invested in. I think they call themselves the Airbnb of warehouse logistics. Mm-hmm. Can you tell me a little bit more about this company and how it might fit into this overall landscape of changing retail and logistics?
Yeah, I think Amazon is creating a tectonic shift in logistics and retailing. It's pushing everyone to be very consumer focused, to move away from 4 or 5 day shipping to 1 to 2 day shipping to even 30-minute movement. And so all of the retailers and shippers and logistics groups are thinking about how to be more agile. Flex in many ways is a solution for them to be able to be more agile and have more distribution centers. So we're really excited about the opportunity. We think it's part of a broader trend in logistics, and kind of Airbnb and Amazon. There are major shifts that are pushing a lot of people to rethink their business.
When you invest in these companies that are spurring automation and perhaps leading to the loss of jobs, we're in this unique climate right now. Do you worry about the optics of that and that the president might make one of your companies a target?
I think what we try to focus on is a lot of times with technology, while there's displacement of jobs, it ends up creating new jobs. There's the analogy of dishwashers didn't exist. There were people that were doing it. Dishwashers were invented, displaced that job, but someone has a job fixing dishwashers. Now, How long that displacement takes is up to question.
But you're optimistic that the economy can recover, can create new kinds of opportunities for the ones that are lost.
That's the hope. I think that's all.
Have we seen evidence of that so far?
Yeah. I think that's a great example, right? Where new technology, there were jobs you could never have thought of before the technology was invented, and that keeps happening over time. The question is how quickly can you replace those jobs in those same regions?
Well, great. Well, Ryan Sarver, you are staying with us. And a reminder that you can watch President Trump's speech live in full on Bloomberg TV, Bloomberg Radio, and Bloomberg.com. Our special coverage begins at 9 p.m. New York time. And coming up, another controversy at Uber as a top executive resigns after just a month on the job. More details next. This is Bloomberg.
I'm Elisa Parenti, and you're watching Bloomberg Technology. Let's start with a check of your first word news. Russian President Vladimir Putin says Moscow will not support new sanctions against Syrian President Bashar al-Assad. Putin made his remarks following a state visit to Kyrgyzstan. After talks with that country's president, he said any new sanctions on Syria would undermine trust in the negotiation process. A new UNICEF report warns about a human tragedy that could last generations if action is not taken against the abuse of refugee women and children along the Mediterranean migration route. Most children interviewed complained about violence, harassment, or aggression at the hands of adults during their journey. Nearly half the women and children reported sexual abuse. Britain's Brexit minister urged his cabinet colleagues to prepare for the possibility that there will be no divorce deal with the EU. David Davis called that an unlikely possibility, but he said it's important that government departments understand the challenges of negotiating an exit from the EU. The IMF says Iran's economy pulled out of a recession after that nuclear deal. The agreement cleared the way for the country to again sell oil on the international market. Iran's GDP is up 7.4%, mostly due to oil. The IMF says uncertainty over future sanctions could cause fiscal trouble. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Elisa Parenti. This is Bloomberg. It's just after 5:30 p.m. Tuesday here in New York, already 6:30 Wednesday morning in Singapore. I'm joined by Bloomberg's David Ingles with a look at the markets. David, good morning to you.
And a good morning from Singapore, Lisa. Yeah, I mean, when we look at markets today, it's obviously going to be very quiet the next 3 hours or so. In fact, when you look at the markets open at the moment, we are already seeing some risk-off positioning ahead of that speech later on. I mean, suffice to say, there is ample room for disappointment. You know, we talk about how vague the speech can possibly be, all of that considered as well. A lot of people here in Asia are now starting to look at these markets, especially some parts like Hong Kong, for example, as maybe a little bit overbought or at least close to it. You look at futures for Australia, futures for Japan, all signaling that we could see an underwhelming start to the day. I'm also watching currencies obviously very closely as well. It's so far a strong dollar story. But again, I mean, all this could change, and expect these charts to dance a little bit more a bit later on. Subplots, Aussie GDP and China PMI due out. And, yep, we're just sitting on the fence here, waiting for that speech. I'm David Ingles here in Singapore. More from Bloomberg Technology next.
This is Bloomberg Technology. I'm Selena Wang. A headline crossing the terminal right now, Amazon Web Services says it has resolved its data storage issues. Its S3 service is now operating normally. The outage appeared to have started at around 12:30 Eastern Time. The S3 data storage system is used by nearly 150,000 websites. Now to another development out of Uber, which has been facing battles on many fronts. Senior Vice President of Engineering Amit Singhal resigned after the ride-hailing company learned of a sexual harassment allegation from his previous job at Google. He has denied the allegations. Plus, a new dashcam video has surfaced of CEO Travis Kalanick riding in an Uber in February, talking about the company's culture as well as getting into an argument with the driver. Ryan Sarver, Redpoint Ventures partner, is still with us, as well as my co-host for the hour, Brad Stone. Brad, let's start with you. What exactly did this video reveal, and why is it important?
Well, it's really an unscripted moment. I mean, Uber's corporate culture has been in the news lately ever since Susan Fowler, a former engineer, wrote a pretty scathing blog post about her experience at the company. Then we received basically a dash cam video from a longtime Uber driver who's unhappy about the direction that pay for drivers has been going. He sent that to us, and have a listen. So in this conversation, which takes place on Super Bowl Sunday, Travis is actually talking to some friends about the culture at Uber and how the company is doing. Have a listen.
My year is coming up, maybe 40.
I make sure every year is hard.
Yes, Christine's birthday. Saturday, by the way.
So Ryan, you've had to counsel many a CEO and a founder through, through these unflattering moments. What do you tell them when they're in the kind of vortex of bad news, like Uber is right now?
Yeah, I mean, I think it's true for any company. Like any crisis that happens, it's about truth seeking. How do you try and get to the root of what's going on and know that most of the infrastructure in the company around you is there to try and hold bad information away from you? So you have to be actively and aggressively looking for that truth and then try and figure out how to solve it quickly and communicate as clearly as possible.
Well, I can't say, we thought a lot about, whether to write this story, but it seemed to me that, Travis's personality is really kind of central to all these questions. This is a company that has changed how cities work, and he's not only talking about the culture of Uber, but really kind of showing a little bit of his pugnaciousness, right, his personality. So have a listen to this second clip where the driver challenges Travis Kalanick about the issues around driver pay, and he responds somewhat forcefully. Have a listen.
You know what? What? Some people don't like to take responsibility for their They blame everything in their life on somebody else. Email for phone card. Good luck.
Brad, that was some pretty surprising stuff. What do you think this really reflects in terms of Uber's culture? Is there really a trickle-down effect? I mean, when you have a CEO that says rather pugnacious things like that, what does that mean for the overall company?
This is why actually Uber has been successful because, Travis, he doesn't suffer fools. He has bowled over every regulatory and competitive challenge in his way. The issue is that he has to be a politician now, right? He has to deal with these very sensitive constituencies. And here's maybe an example of him not putting his best foot forward. And Ryan, I'm curious to hear what you think. I mean, you're friends with some of these folks on the Uber management team, and you've known Travis for a long time. Do these CEOs and founders now have a responsibility to be a little less pugnacious and more politically astute?
Yeah, I think any company that ascends in the way they have and other companies have, there's a point where you're fighting as an outsider for a long time, and suddenly you're someone everyone else looks at, and there's a transition that happens, and you see some leaders make it and some don't. And I think they're going through that transition now. I mean, watching this, I'm curious to see and think through, like, you guys get something like this dropped on your doorstep. Like, how do you think about the process of assessing that and whether you publish it or not? Uber's a utility now. It's changed, the way these cities operate, and Travis's personality and Uber's culture is so very much in the news right now. So it seemed to me that when we got this video, that we really didn't have any choice. It's very much topical, and it is another one of these unscripted glimpses about the man and about the company.
Fortunately, we're going to have to leave it there for now. It's a fascinating and ever-developing story. We'll see you after the break, both of you. Coming up, YouTube is taking on traditional cable companies. Our conversation with YouTube CEO Susan Wojcicki about their newly announced TV service, next. Salesforce reported its fourth quarter results after the bell. Although the company beat estimates, it gave a weaker forecast as competition from other cloud software companies heat up. Salesforce now forecasts that revenue in the current period will be $2.34 billion. Now YouTube is going primetime. Announced a new service today called YouTube TV that will deliver an assortment of major TV channels to paying customers for $35 a month starting this spring. Bloomberg's Lucas Shaw spoke to Susan Wojcicki earlier, who is CEO of YouTube, and he spoke to her at an event in Los Angeles. He started by asking her about the details of the new service.
Well, we see that on YouTube, we have a lot of demand for TV content. And we think it's a great opportunity with the mobile phones because everyone's carrying a TV around with them in their pocket, but they're just not using it for TV. So we saw this giant opportunity of how can we take all this amazing TV content and make it available to a generation that loves content, but they want their content on demand. They want to watch it on any device. They want to not have the commitments that are currently required for TV. And so we just saw a big opportunity to bring the full TV experience to our audience.
Now, with all these TV networks, these are owned by companies that in the past YouTube has had somewhat of a tortured relationship with, fighting over piracy, copyright, all sorts of things like that. Did you have to make any assurances about those topics, or how are they to deal with in these negotiations?
Yeah, well, we actually work with all of the large broadcasters and the networks to bring that content onto YouTube now. We have clips, we have shows, so we've had a good relationship with them, and I think they've seen the opportunity to use YouTube as a mechanism to get more promotion for their shows, to have time-shifted versions of their show on YouTube. And so this is really just taking it to the next level.
Right. Now, you've experimented already. I mean, most people think of YouTube as this big free this place where they can go and get video for free. You experimented with paid with YouTube Red, which you rolled out last year. What have you found about YouTube users' appetite for paying for something, and what is the future of YouTube Red now that you have this other full TV service?
Yeah. We think there's an opportunity for users to be able to also have a subscription service. And so while the free ad-supported model is a wonderful model, and we're investing in that, we see an opportunity with TV content to be able to offer that to our users for the $35 a month for the 6 accounts. And so that's an exciting opportunity to expand to a new type of content and to make that available to our users.
Yeah. Do you think this service then kind of helps boost the business of YouTube? Does it increase your chances of kind of generating serious profits? Does it help lift advertising revenues?
Well, I think what we see is that an opportunity to be able to offer TV content to our users in a way that they're used to consuming content. And so if you look at this generation of the cord nevers, at the cord cutters, at the millennials, they expect their content to be on demand. They expect it to be cross-platform. And so we just saw a really big opportunity to be able to bring this amazing TV content to this generation and connect them with content in a way that they expect to consume TV content.
Yeah. Do you think there's any TV content that's missing from it? You have some of the broadcast networks. You don't have some of the big cable networks from Turner or Discovery or Viacom. Is that something that'll change?
Well, it's a new service, and so it's certainly always evolving, but we feel really happy with what we have right now, and we think we offer a really great set of content that's available for a low price of $35 for 6 accounts.
Yeah. What do you think is the big differentiator between this and some of the other live services out there, like the ones that are coming from Hulu and DirecTV and Sling?
Well, we hope that the biggest differentiator is it's just a great experience. And so when our users use it, everything works in a way that they expect it. So everything works seamlessly cross-device, that we have an unlimited cloud DVR storage, so you can quickly and easily save everything, that you have no commitments when you sign up, and that you have great search. And so these are all things that we, as a technology company, have spent years developing, and now we're excited to bring this to TV.
Yeah, where do the normal YouTube creators that people spend so much time watching already on the service, where do they live within this TV service? Is it part of it, or are they separate from your regular cable network?
Yeah, so the YouTube creators, we're going to have some YouTube content as part of this service. The episodic content, we'll also have the top trending on YouTube available. And so we're excited to bring those 2 parts of YouTube to this service. And then, of course, the original content that YouTube is creating as part of YouTube Red will be available on our YouTube TV product.
Will it be available for the $35 monthly price, or will you have to be a YouTube Red subscriber?
So the YouTube Red Originals will be available included for the $35 price for our YouTube TV product.
Right. And, you know, one thing that you've stressed in this service and a lot of the new live services stress is sports, because that's something that, you know, you have highlights on YouTube, but you don't have the live sports. Do you see yourself bidding for sporting rights in addition to what is already available on YouTube?
Well, the goal of this product is to be able to offer TV content and have a great TV content experience, which includes a lot of live sports. And so via our partnerships with all of the broadcaster and networks, we have a really comprehensive sports offering for our users with this product.
That was YouTube CEO Susan Wojcicki speaking with Bloomberg's Lucas Shaw. Let's now bring it back to our guest, Ryan Sarver, partner at Redpoint Ventures, who is an investor in both Netflix and TiVo. Okay, so Susan gave the classic answer that what makes them different is that they have this great user experience. But do you think they're actually going to be able to lure millennials to buy into this subscription service on top of Netflix, Hulu, HBO, you name it?
It'll be interesting to see. I mean, user experience can matter, but I think more importantly, they have the audience. They have that millennial audience that is watching the YouTube creators on their everyday billion hours of video. So it'll be interesting to see if this add-on package is something they go towards. You know, millennials generally have shifted away from kind of traditional media and the traditional shows people care about. So it'll be interesting to see if this actually matters to them, if they care about it. But they have the audience.
If you're sitting in the offices of a Comcast or a DirecTV, does it feel like the noose is tightening now, that this is just another one step towards the great unbundling?
Losing the grip, the unbundling and the rebundling? Potentially, yeah. I think you start to become the pipe a little more. They're trying to invest in their own content as well, and so I think there's this crazy battle going on, a lot of shells moving around.
Well, Susan mentioned that they don't offer everything because they don't have to pay the high licensing fees. So, Brad, what are they not offering?
It seemed from Lucas's interview that they don't have the kind of cable-only networks, the Bravos, perhaps the news networks, and of course sports. Right, that's a big omission. I mean, we're talking about millennials unbundling, going to one of these skinny bundles, either a YouTube or a Hulu. Do they care about that? I mean, is that enough to keep them tethered to the cable or satellite subscription?
I mean, I tried to. I moved houses, I tried to unplug, and I went back for sports. So for me, it matters, and I think for that audience, it's going to matter at some point.
You do have to wonder, though, if YouTube is spending the money, right, to do this, and probably losing money on that $35 a month. To what extent are they next in line to go and bid for one of those nights of NFL coverage or a Major League Baseball game of the week? Of course, we heard this week, I think, that Facebook was talking about streaming a game. So it seems to me, a baseball game, it seems to me that we are moving into this world where maybe those things that are left out of these internet bundles, that category is beginning to shrink.
Yeah, they've been reporting over the years that Google has been bidding on NFL rights. NFL viewership is down, though, right? And so they have to try and take that into account if that's going to be the long-term thing. So it's going to be a big bet for somebody. They got to figure out if they're the right one or not.
And speaking of the other companies in this space, there's Apple, Amazon, and Google. What's their competitive edge? Do you think that their search capabilities, AI, is going to be able to make this more personalized than some of the other offerings?
I think personalization matters a little bit, but not as much as their showing original content does. From Netflix originals to Amazon originals. Amazon just won 2 Oscars. Like, everyone seems to be investing in the original content because that's what draws people into platforms and gets them to stick there.
Ryan, we mentioned Netflix earlier. If you're Netflix right now, do you worry about this? Do you feel like you need a so-called skinny bundle to keep up with what YouTube is doing and Hulu and perhaps one day Amazon?
I think they're different offerings. I think you're going to get different things out of those different packages, and you're going to see people have maybe 2 or 3 different packages. If I were Netflix, I wouldn't be too worried yet, but definitely watching.
Well, maybe we'll have to be on the lookout for a future YouTube Oscar. But that wraps it up for today. Redpoint Ventures' Ryan Sarver, thanks so much for joining, and thanks to Bloomberg Technology's Global Executive Editor, Brad Stone. Coming up, Google's play to dominate the virtual assistant market with artificial intelligence. We head to Barcelona to get the latest from Mobile World Congress. This is Bloomberg. And a mover that we're watching, GameStop fell the most in 4 months after the trading session over investor concerns on rising competition. Microsoft has announced it's introducing a subscription service that would let customers play games online and avoid a trip to the store. Now, Google is sharing its virtual assistant feature with Android partners, and the service answers queries, plays music, and completes tasks, and will now expand beyond Google's Pixel to smartphones with the latest version of the Android software. So what exactly is behind the expansion strategy? Bloomberg's Caroline Hyde sat down with Gumi Hafenstun, product lead for the Google Assistant.
We're providing a single assistant, so it's one product you can get to, but it's offered in different places. So it doesn't matter whether you're using the assistant on your Pixel phone or in Google Home, it's the same assistant, and you can get the same level of functionality across all those different devices. So that's like it's a very powerful concept as you go through the day and you move between different situations. You still have the same power of Google providing you help anywhere you want it.
So the news here is that it is now available across more Android platforms.
Yep.
I can get Google Maps on my Apple phone. Would I be able to get your assistant not only on my Samsung but also on an Apple as well eventually?
So that's if I may just talk a little bit about sort of what led us to this moment. So if you think to last fall, we launched the assistant on Allo and Pixel and Google Home, the voice activity speaker. And since then, we've been basically to try to get to more places because we want users to be able to access the assistant as easily as possible. So we have announced that it's coming soon to the car, it's coming to your TV. Early this month, we launched it on the Android Wear 2.0, so the new watch, the new smartwatch. And so this is just a natural progression now, adding it onto all Android devices with Marshmallow and Nougat that run Google Play services. So you can see the trajectory. We clearly want it to be in every device possible, and so you can just sort of paint the picture future with that.
Does the assistant eventually replace search?
No, the way I think about it is the assistant is a conversational interface to help you get things done. And so now you have a way that's a very natural way for you to talk to technology. It's think about it as, instead of us learning how to use technology, we want to adapt technology so it learns how we talk. And through that means the assistant can do all kinds of things. And that includes interacting with search, but it can also do local searches. It can turn the lights on in your home. It can set the kitchen timer for you. It can play music. It's really a lot of different services, and it includes search as one of the core services, including answers to questions and things like that.
What about some of the privacy issues that have been shone a light on through the rise of virtual assistants? How are you tackling it?
So first, before I even dive into this, I mean, privacy is clearly a very important thing to us, and we want to make sure that it's clear to users what's going on and how the data is being handled. To me, it's a lot about control and transparency. So we have what's called My Activity, which is a place you can go to. You can see all the interaction with the assistants. You can delete things if you don't want them to be there. So it's fully under users' control. And to us, it's very important that we're building a relationship of trust between the user and the assistant. So we are constantly making sure that this is taken care of perfectly well. And then obviously, on the other hand, we want to make sure we're providing the value that users expect from the product. So those kind of go hand in hand together, make sure they have a solid product with a solid privacy foundation.
And the issue that it might always be listening, how are you tackling that ongoing debate in the press?
Well, so first of all, it isn't.
Yeah.
I think that's clear to me. It only triggers when you actually say the hot word. And so you have to actually say the hot words in order to do that. In addition to that, on Google Home, lights show up, so it's clear that it's now you're listening to, you can talk to it. There's a physical mic button on the back. And if anything accidentally goes in, again, you can go to My Activity, you can delete anything that you don't want to be there. So you're perfectly safe in terms of knowing what's going in and what's not going in.
Now that was Gumi Hafstensson, product lead of Google Assistant. And now that does it for this edition of Bloomberg Technology. Caroline Hyde will be back on Wednesday, just in time for the much anticipated Snap IPO. This is Bloomberg.